What if I told you that 5 losing trades in a row doesn't mean your strategy is broken? Every year, thousands of traders abandon strategies that actually work. They hit a rough patch, panic, and move on to the next thing. Then they hit another rough patch with that strategy and quit again. They spend years doing this, convinced they just haven't found the right system yet. But the problem isn't the strategies. It's that they never stuck with anything long enough to find out if it actually worked. Take a coin and flip it 10 times. Getting 7 heads and 3 tails wouldn't surprise you, right? That's 70% heads, even though the real probability is 50%. You could even get 7 heads in a row. Would you think the coin is rigged? No, because you know 10 flips isn't enough data. But flip that coin 1,000 times, and you'll get close to 50/50ths. Maybe 520 heads and 480 tails. The more flips, the clearer the real probability becomes. This is sample size, and it applies to your trading, except the stakes are way higher than $1 per flip. Here's what happens to most new traders. They find a strategy with a 60% win rate. They backtest it. Looks good. They start trading it with real money. Then they hit 3 losses in a row. They panic. They're convinced the strategy is broken and they abandon it. But here's where sample size comes in. If you make 50 trades with this strategy, what are the chances you'll see at least one 3-loss streak somewhere in those 50 trades? Over 99%. It's practically guaranteed. You will see a 3-loss streak, probably multiple times. What about 300 trades? You're absolutely going to see multiple 3-loss streaks. In fact, you're also guaranteed to see a 4-loss streak, a 5-loss streak, and probably even a 6-loss streak. Not because the strategy is broken, but because that's what normal variance looks like over hundreds of trades. So when a trader hits 3 losses in a row after 10 trades and quits, they're not discovering a flaw. They're witnessing something that happens to everyone who trades this strategy. The difference is some traders understand this is normal and keep going, while others think they've uncovered a problem and quit. Same strategy, same math, completely different outcomes based purely on understanding sample size. Let's look at this from a different angle. Imagine a basketball player who makes 70% of their free throws. That's a really good shooter. Now, they step up to the line and miss. Then they get fouled again and miss the second one. 2 misses in a row. Does the coach bench them? Does the player think they've lost their ability to shoot? Does everyone panic and assume something's fundamentally broken? No, because everyone understands that even a 70% free throw shooter will miss occasionally. They might miss 2, 3, even 4 in a row sometimes. It happens. But in trading, people don't think this way. A trader with a strategy that wins 70% of the time hits 3 losses in a row, and suddenly they're questioning the meaning of life. They're looking for what they did wrong. They're tweaking the strategy. They're changing rules. Or worse, they're abandoning it completely. The strategy isn't broken. The trader's understanding of probability is broken. Let's make this really simple. You have a strategy that wins 60% of the time. Here's what actually happens at different sample sizes. 10 trades? You could easily end up 50/50 or worse. Happens all the time. The strategy works, but 10 trades isn't enough to show it. 20 trades? Still totally normal to be at 50/50 or even losing. You're building data, but you're not there yet. 50 trades. Now we're getting somewhere. The real win rate starts to show up, but you could still be off by quite a bit. 100 trades? This is where things get clear. If you're still at 50/50 or worse after 100 trades, okay, now you might have a problem. But before that, you just don't know yet. Here's the key point. After just 20 trades with a 60% strategy, you could have anywhere from 8 wins to 14 wins, and that's all completely normal. Same strategy, massive difference in what it looks like. That's variance. That's why small sample sizes lie to you. Here's something most people don't realize. Small sample sizes test the trader. Large sample sizes test the strategy. When you're in your first 5, 10, 15 trades and things aren't going well, that's not testing whether the strategy works. That's testing whether you can handle normal variance. Can you stick to your rules when you're down? Can you keep executing when doubt creeps in? Can you resist the urge to abandon ship? Most traders fail this test. They think they're evaluating the strategy, but really the variance is evaluating them. And they quit before they ever get to the part where the strategy actually gets tested. The strategy gets tested at 30 trades, 50 trades, 100 trades. That's when the sample size is large enough to cut through the noise. That's when you can actually see if your edge is real. But you have to survive the first test to get there. You have to prove you can handle being a trader before you get to find out if you have a trading strategy worth keeping. Now, there's a reason this is so hard for traders. Our brains aren't wired for this kind of thinking. We're pattern recognition machines. We see 3 losses in a row, and our brain screams, "Pattern detected. Something is wrong. Take action." That instinct kept our ancestors alive. If you ate 3 bad berries from a bush, you didn't stick around to try the 4th one to get a better sample size. But trading isn't berries. The problem is that our emotional response to losses doesn't understand statistics. Each loss hurts. Each loss feels meaningful. Each loss feels like evidence that something is wrong. When you're watching your account balance drop with each losing trade, your brain isn't thinking about sample size. It's thinking about survival, about being wrong, about losing money. This is why even traders who intellectually understand sample size still struggle with it emotionally. Knowing something in your head and feeling in your gut when real money is on the line are 2 completely different things. Here's where this gets really destructive. A trader doesn't understand sample size. They try a strategy, hit a normal losing streak within the first 10 or 20 trades, and quit. Then they find another strategy. Same thing happens. Losing streak hits, they quit again. They might go through 5, 10, 15 different strategies this way. And here's the tragedy. Some of those strategies were probably good. Some of them probably had real edges. But the trader never stuck with any of them long enough to see that edge play out. They kept quitting when they should have been continuing. They mistook normal variance for strategy failure. Even worse, they start to build a mental pattern. They begin to expect failure. They develop a hair trigger. The moment they see a few losses, they're out because they've been through this before. They're protecting themselves, or so they think. But really, they're guaranteeing they'll never succeed because they'll never give anything enough time to work. Strategy hopping feels like taking action. It feels like learning and adapting. But without understanding sample size, it's just running in circles. You're not finding better strategies. You're just resetting your sample size over and over, never letting any edge reveal itself. Now, here's an important point. Sample size cuts both ways. Just like you shouldn't quit a strategy too early, you also shouldn't stick with a losing strategy forever just because you don't have enough trades yet. If you made 100 trades with a strategy that's supposed to win 60% of the time, and you're only winning 35% of your trades, that's a problem. The math says that's extremely unlikely to happen with a genuinely good strategy. At that point, more data is telling you something real. The strategy might not work in current market conditions. You might be executing it wrong. Something is genuinely off. This is the balance. Small samples tell you nothing. Large samples tell you everything. The question is, where's the line? For most trading strategies, you're looking at a minimum of 30 trades before you can start to draw any real conclusions. 50 is better. 100 is where you can really trust what you're seeing. But those first 10, 20 trades, they're basically noise. They might make you feel good if they're winners, but they don't prove the strategy works. They might make you feel terrible if they're losers, but they don't prove it's broken. They just don't tell you enough. Professional traders understand this deeply. They're not more emotionally stable than you. They're not immune to the pain of losses. They just have a framework that lets them contextualize those losses differently. When a professional trader takes a loss, they're asking different questions. Not, is my strategy broken? But was that loss within the expected parameters of my strategy? They're tracking their statistics over meaningful sample sizes. They know their expected win rate, their average winner, their average loser. They know what normal variance looks like for their specific approach. They also separate the quality of their decision from the outcome of the trade. This is crucial. You can make a perfect trading decision and still lose money. You can make a terrible trading decision and still win. The individual result doesn't tell you if the decision was good. Only a large sample of results can do that. This is why pros can take 5 losses in a row and not blink. They're not being cocky. They're not in denial. They're just operating with a proper understanding of sample size. They know that 5 trades tells them almost nothing about whether their edge is working. They'll check their execution, make sure they followed their rules, and move on to trade number 6. Okay, so knowing all this is one thing. But what do you actually do when you're staring at your 4th loss in a row and your stomach is in knots? Here's what works. Before you start trading a strategy with real money, write down a number. Could be 30 trades, could be even 10. That's your commitment. You're going to trade this thing for that many trades before you even think about whether it's working. Why does this help? Because right now you're calm. You're thinking clearly. After 5 losses, you won't be. That future version of you needs this decision already made. You're making a deal with yourself when your head is clear, so you don't have to make it when it's not. Also, and this one's harder, stop seeing losses as failures. A loss is just another data point. That's it. A strategy that wins 60% of the time loses 40% of the time. Those losses aren't mistakes. They're part of the strategy working exactly as designed. Each loss moves you one trade closer to having enough information to actually know something real. You're not losing trades. You're collecting samples. Sounds like semantics, but it changes how each trade feels. Here's the paradox of all this. The traders who succeed are patient enough to stick with strategies through losing streaks, but they're also honest enough to abandon strategies that genuinely don't work. The key is knowing the difference, and you can only know the difference with proper sample size. Quitting after 5 trades? Way too early. You learn nothing. Sticking with something through 100 trades when it's clearly not working? That's not patience, that's stubbornness. The sweet spot is that middle ground. Enough trades to actually see through the noise of variance, but not so many that you're just grinding away your account on something fundamentally broken. Most traders err on the side of quitting too early. Way too early. They're optimizing for feeling like they're taking action rather than optimizing for actually finding out if something works. Action feels good. Waiting feels passive. But in trading, sometimes patience is the most powerful action you can take. If you take nothing else from this, understand this. Your first 10, 20, even 30 trades with a new strategy don't tell you much. They feel significant. Each one feels important. But mathematically, they're just the beginning of collecting data. The real information comes later. This means you need to approach early trades with a specific mindset. You're not trying to make money yet. You're trying to execute the strategy correctly and build up your sample size. The money comes later, after you've proven to yourself with enough data that the strategy has an edge. This also means you need to size your positions appropriately. If you're going to need 30 or 50 trades to really know if something works, you need to make sure you can survive 30 or 50 trades. If you're risking too much per trade, a normal losing streak will knock you out before you collect enough data. Position sizing isn't just about risk management. It's about giving yourself enough runway to actually see if your strategy works. Trading is a game of probabilities playing out over many, many repetitions. Not a few trades, not 10 trades, many trades. If you can't embrace that, if you need each trade to be meaningful on its own, if you need immediate validation that you're on the right track, trading is going to be extremely difficult for you. The uncomfortable truth is that you can do everything right and still lose for a while. You can have a great strategy, execute it perfectly, and still hit a rough patch. That's not a bug in trading. That's a feature. That's how probability works. Edge is an advantage that plays out over time, not a guarantee on any individual trade. This is why trading psychology is so important. It's not about being fearless or ultra-confident. It's about being able to execute your strategy consistently even when the short-term results are discouraging. It's about trusting your process and your data more than your feelings. It's about understanding that variance is real, losses are normal, and sample size is everything. Sample size matters more than almost anything else in determining whether your trading strategy works. More than your feelings about it. More than the last few trades. More than how confident or discouraged you feel. The math doesn't care about your emotions, and the market doesn't care about your sample size. You need to care about your sample size, because that's the only way you'll ever know if you have an edge. Losing streaks are normal. They're expected. They're baked into the math of any probabilistic system. A losing streak doesn't mean you're a bad trader or that your strategy is broken. It just means you're experiencing normal variance. The only way to see through that variance is with enough trades to build a meaningful sample. Most traders never figure this out. They spend years bouncing from strategy to strategy, never giving anything enough time to work, always convinced the next thing will be different. They're not failing because they can't find good strategies. They're failing because they never stick with anything long enough to find out if it's good. Don't be that trader. Understand sample size. Respect variance. Trust the process. Give your strategies enough time to prove themselves one way or another. That's how you move from guessing to knowing. That's how you move from reacting to data-driven decisions. That's how you actually build a sustainable trading approach. The next time you hit a losing streak, remember the coin flips. Remember the basketball player. Remember the 3 losses in a row probability. It doesn't mean anything about your strategy. It just means you haven't flipped the coin enough times yet. Keep trading. Keep tracking. Keep building your sample. The edge reveals itself to those who are patient enough to let it.